D.K. Joshi, Chief Economist at Crisil, who now joins in live. So Joshi, the first point I'd like to bring up is with respect to the comments made by the RBI Governor Raghuram Rajan saying that the decision to hold rates was a close one. If we perhaps read into it, although he has stated time and again that he is not going to, react to every data point that comes out, can we brace ourselves now for some more rate hikes by the Reserve Banks?
Well, I think that's an open question because if you look at the headline inflation numbers, whether it is WPI or is it CPI, I think both of them are outside the comfort zone. What I think the governor did this time in the mid-quarter policy was he ignored the vegetable inflation, which is the right thing to do because there was what can be called as a fleeting surge in vegetable inflation, and which has already started correcting itself. So it was in a sense correct to ignore it because he termed it as noise because it was one-off and was not going to continue in the next couple of months. So I think that's one aspect of it. The second aspect is that there are many other commodities where I think food commodities essentially where inflation continues to remain high and might still remain above the comfort zone even with a good monsoon year because we have structurally moved up as far as the food inflation is concerned. The food inflation has averaged close to 10% in the last 8 years. That average used to be 5% per year in the decade before that. So I think there is a genuine pressure from food inflation which is persistent in nature. I think he was right in ignoring vegetable inflation, but whether he'll be able to ignore the overall high inflation going ahead, I think that's an open question, and we should be prepared for surprises going ahead.
So just to dwell on that point, with the rise that we've seen in the vegetable prices, which is of course the key culprit in the high food inflation as you flagged off, do you think that fear of entrenching inflation is going to now absolutely scrape off any hopes of a deflationary scenario that many were working with at some point?
Well, there's there's some disinflation there, but I think deflationary scenario is definitely not there. And as far as the expectations getting entrenched is concerned, I think people have been facing high inflation year on year for several years now. So there is a general expectation that inflation is going to remain high. There might be a cyclical upturn and downturn. I believe we should see a downturn in inflation somewhat because as the harvest comes into the market, the food inflation will moderate somewhat, and that is what we have been seeing over the last couple of years. But I think the essential point is that the persistent pressure from food and also now from fuel is I think is a reality that you have to live with. And so inflationary expectations definitely do get entrenched in such a scenario, and we might see a brief respite, as I said, but how long will it last is a question mark.
So if indeed rates don't look like coming down in a hurry, if not going up, even if not going up, how does that impact the growth scenario for Q4? Because I believe a lot of people will be pegging their hopes on Q4 turning out wonderfully well for the FY14 GDP number to look respectable.
Well, I think my sense is Q4 will be better, but the RBI's policy will not have any impact on Q4 because there is a lag, and I think the lag can extend up to 1 year. So what central bank does now will only have impact in future. So for Q4, I don't expect much impact of whatever action central bank takes, but we do expect Q4 to turn out to be better than the previous quarters for the simple reason that the full thrust or the bonus of a good agriculture year or good monsoon will be visible, I think, in the third and fourth quarters going ahead, and I think that will keep the growth close to 5% or maybe 5%. I think that's the upside that we are anticipating right now, which is a very mild lift.
Yeah, mild lift at that. But what about the other factors surrounding the fiscal situation? CAD is of course forgotten now. Most people bury it as the ghost of the past. What about the fiscal deficit situation? How do you expect that to shape up? You think 4.8 is...
Well, I won't bury the... Sorry, I won't bury the current account deficit as yet, because part of the decline in current account deficit is due to artificially controlling the gold imports, and part of it is also due to the slowdown. And I think as if and when we lift the restrictions on gold imports, we should see some spike in gold imports and consequent spike in the current account deficit also. As far as the fiscal situation is concerned, I think there's a worry there, because clearly the revenues have fallen short. The government has kept a tight leash on expenditures, but that's not enough to bring the fiscal deficit down to 4.8%. We haven't done too well on the divestment front. Only about 10% of the annual target of 54,000 crores has been achieved. So there is a fiscal pressure, and how government is going to ensure that fiscal deficit stays at 4.8% of GDP, we'll watch out and see. But my sense is that eventually there would be a cut in expenditure, which will bring you closer to that target. Without that, we see the fiscal deficit ending up at 5.2% of GDP and not 4.8%.
So Joshi, the fact that the rupee has just not scaled down from those levels of 61.5 thereabouts, do you think that as long as the QE taper concerns continue to linger, we will see more pressure on the currency?
Well, I think QE taper in a sense that we are definitely much better prepared, because there was an actual announcement of taper this time, unlike in August where the Fed had, I think there was a mere speculation that Fed is going to taper, and that was enough to drive the rupee down to 68. But if you look at the behavior of rupee this time around, I think it's more or less, there are some fluctuations, but more or less it seems to be stable at these levels. Given a couple of basis points here and there. Now, it's obviously a function of two things. I mean, one, that the current account deficit has materially come down, and second, that we have used this window that was available to us in terms of when the Fed decided to postpone the taper. That window we have used to shore up our foreign reserves, in a sense that the FCNRB deposit scheme, the swap agreement with Japan, etc. I think all those things have ensured that we are better positioned. So as a consequence, I think your vulnerability is low, and the shock that came did not have much impact. So my sense is that rupee will continue to remain around these levels, and our official forecast is rupee at 60 by March 2014.
Okay, fingers crossed that we do see those kind of levels. And when it comes to the bond yields, which are at those 1 year a month highs, where do you see that trending?
Well, I think, our expectation is that bond yields will also soften, and we should see a couple of basis point decline in the yield by the end of the year. And our forecast is around 8.5%, which seems a sharp decline from the current levels. But I think that's where we see the bond yield stabilizing.
How do you see the liquidity situation as a whole shaping up, given the kind of measures that have been consistently taken by the Reserve Bank?
Well, I think RBI Central Bank will maintain liquidity in the deficit mode. I think that is for sure. But overall, I think it will still remain. It will remain comfortable, because the worries on the exchange rate front have moderated somewhat. So RBI doesn't have to be overactive on the liquidity front to address the issue of rupee. And I think MSF also has been reduced quite significantly over the MSF rate. So I think as a result, I would see liquidity in a more or less comfort zone, and the credit growth also is expected to be mild this year, 13-14%.
I know I'm drawing the conversation back to where we started from, but I heard you mention that we are in a scenario of persistently high inflation. So my question really is, do you believe that inflation could stubbornly stay at these elevated levels for the next maybe 6 months, and therefore, till we hit the general elections, do you believe rates would definitely not come down?
Well, I think my sense is inflation is definitely going to come down from these levels, because vegetable inflation which was one of the culprits, is already started nudging down, and so overall food inflation will also be lower. So I do expect both CPI as well as WPI to be lower than what they are currently. But I think the issue is what level gives comfort to the central bank. I think that level till now people believe is around 5%. So it's not going to come down to those levels. So that essentially means that the central bank will have less freedom to cut rates going ahead. So I don't visualize rate cuts in the next 5 to 6 months.
Mr. Joshi, we'll leave it at that. Appreciate you taking the time out, joining in with that extensive perspective on your side from where you see the macros headed.